Today's highlights. Bitcoin's buying momentum has cooled off, but altcoin trading volume has already surpassed 50%. Looking at the data, altcoins are indeed showing signs of a rebound. Nominated by Trump himself, Kevin Warsh distanced himself from the White House during the hearing.
I was honored he nominated me.
Today, we'll detail how past Fed chairs have driven crypto bull and bear markets. Once Kevin Warsh takes office, can he just cut rates at will?
The president never once asked me to commit to any particular interest rate decision.
Wednesday, April 22nd. This is BitcoinTV's Chinese channel, BLHZ. I'm Michael. Our program is broadcast daily in Japanese, Korean, Thai, Spanish, and English by local anchors in their native languages. First, let's look at the essential 24-hour crypto data summary. Bitcoin is currently up, but selling isn't out of control. Rather, buying is just very weak. Risks in the Strait of Hormuz continue to escalate. Look, the SSR has dropped to 11.15 and it's broken below short-term moving averages, showing very low interest from new capital entering the market. However, the supply side hasn't budged. Miners' unrealized profit margin is only 0.1383, lower than the network-wide MVRV of 1.40. Meanwhile, exchange inflows for CDD and older UTXO remain low. What does this mean? Large holders aren't selling off in bulk. Simply put, the demand side is just very weak and hesitant. It's not a collapse of holdings. Interestingly, Binance's altcoin trading volume has risen to about 51%. This was only 31% in early March. Bitcoin is at about 30% and ethereum is at 17%. This suggests the limited liquidity left in the market is seeking excitement in altcoins. Now, the SUI ecosystem, which everyone's watching, has hit another snag with BTC5 and the liquid staking protocol Volo. An attack was confirmed this morning, with about $3.5 million in assets stolen from 3 specific vault wallets. This involved WBTC, XAUM, and USDC. Fortunately, the $28 million in TVL in its pools is currently safe. The team stated they will cover all losses themselves and won't pass them on to users. The issue is that this security breach reminds us that while ecosystems can grow fast, if protocol security doesn't keep up, confidence will eventually shatter. Fed Chair nominee Kevin Warsh's key message at the hearing wasn't just about rates, but that the Fed will shift focus to balance sheet reduction. That means managing interest while tightening liquidity. So even if short-term rates drop, long-term yields might stay high. Therefore, pressure on risky assets might not ease immediately. But look, on-chain data ignores all that and hasn't weakened. Bitcoin's long-term holder SOPR is near 1.0. What does that indicate? Long-term holders are basically at break-even when moving coins with no large-scale profit-taking. In other words, while the macro environment is tight, on-chain supply hasn't loosened. Thus, selling pressure is limited. So who drove today's price rebound? ETFs. It's the result of continuous institutional buying. The nature of institutional holdings is that if a client wants to allocate, they buy proportionally, regardless of the price. Institutional holding periods are generally at least 3 to 5 years. Alright, crypto prices rose a bit today, right? At their peak, they headed towards 78 or 80,000. The crypto world reacts to every little thing. Why? At last night's Fed hearing, Kevin Warsh was confirmed to succeed Powell. Everyone's imagining that Warsh will cut interest rates immediately upon taking office, right? But don't forget, Powell has consistently resisted political pressure without budging. Now it's Warsh's turn, and the market's main concern is whether the Fed can still implement policy independently. So next, we'll analyze and break down the most critical points from this hearing for you. Because while it looks like a personnel change, it's really about who controls the Fed's money faucet.
The first highlight was direct. Kevin Warsh didn't start by talking about interest rates, but by distancing himself from the White House. He stated clearly that the president didn't ask him to commit to any rate decisions, and even if he had, Warsh wouldn't have agreed. The message is clear. He wants the market to know the Fed chair isn't the White House's rate cut button.
Senator, I am glad you framed it that way. The president never asked me to predetermine, commit, fix, decide on any interest rate decision in any of our discussions, nor would I ever agree to do so.
The second highlight was when the atmosphere suddenly turned tense. Ruben Gallego asked point blank, who is lying, you or the president? With that question, the hearing shifted from rate cuts to testing one specific thing. Kevin Warsh claims he's independent, but should the market actually believe him?
The president never once asked me to commit to any particular interest rate decision, period, and nor would I ever agree to do so if he had, but he never did. I was honored he nominated me. Like everyone else in the committee in the world, I've heard his view on interest rates. It sounded very similar to me to every other president in economic history that I've studied.
The third highlight was Warsh shifting focus back to inflation instead of the rate cuts the market wanted. The point is direct. Even with a new leader, the Fed won't just open the faucet because Trump wants a cut. At the very least, the signal from this hearing wasn't an immediate flood of liquidity.
So you see, this recent surge in crypto prices is a bit baffling. Warsh is a dove, sure, but the first signal from this hearing wasn't about cutting rates. Trump wants cuts, but Warsh immediately distanced himself, saying he'll remain independent despite Trump's wishes. Second, the senator's questions weren't just about policy, but whether the Fed's independence is real or fake. Third, Warsh didn't start with liquidity. He brought inflation back to the forefront. So the question is, why did Warsh repeatedly emphasize the Fed's independence? Because the answer is simple. The Fed was never meant to be a button for the White House. Next, we'll clarify the Fed's underlying logic, what it is, and why it controls the dollar's faucet.
The Fed's full name is the Federal Reserve System, or the Federal Reserve System in English. Known as the Fed, it's the central banking system of the U.S., founded in 1913. It was created because the U.S. used to have frequent financial panics. When banks were in chaos, the market would easily collapse. So, this institution was specifically established to manage the dollar. Its core role involves three things. First, managing interest rates and monetary policy, deciding whether to ease or tighten the money supply, which directly affects borrowing costs, market liquidity, and the price of risky assets. Second, managing financial stability. When banks have trouble or the market faces a liquidity crisis, it steps in to put out the fire. Third, managing the payment and clearing systems. For transfers between U.S. banks and the operation of the financial system, many underlying layers cannot bypass it.
To put it more simply, the Fed and the U.S. government aren't in a superior subordinate relationship within one company. They're more like two separate lines in one system. What is the U.S. government responsible for? Spending money, collecting taxes, and issuing debt. What is the Fed responsible for? Managing interest rates, the money in the market, and the stability of the dollar. In other words, the competitiveness of the dollar is the Fed's responsibility. So, the president is naturally the most influential figure. However, the Fed chair is also nominated by the president to maintain mutual consistency. But nomination doesn't mean they have to follow the president's orders once in office. When it truly comes time to decide whether to cut rates or ease the money supply, the Fed, in theory, must make its own calls and decisions rather than becoming the White House's money-printing machine. The government wants to spend money, but the printing press, the faucet, is in the Fed's hands. The two sides are related, but the president can't just say the word and expect the Fed to fall in line. This is a structure of mutual influence and checks and balances within the U.S. financial system.
And because of this, the conflict between Trump and Powell has always been out in the open. The core of it is simple. Trump wants faster rate cuts, while Powell is unwilling to give in to political pressure. For Trump, low interest rates make financing cheaper, making the stock market look better and benefiting the economic and election narrative. But for Powell, the Fed's priority isn't cooperating with the White House, but first maintaining control over inflation and policy independence.
We have a stupid person, frankly, at the Fed. He probably won't cut today. Europe had 10 cuts, and we had none. We're going to lose because of this. Too late. I call him Too Late Powell because he's always too late. I mean, if you look at him, every time I did this, I was right. 100% he was wrong. Maybe I should go to the Fed. Am I allowed to appoint myself? Doug, I don't know. Am I allowed to appoint myself at the Fed? I'd do a much better job than these people. So anyway, we should be 2 points lower.
So, the next question falls on Kevin Warsh. Think about Trump's personality. Someone who loves grand achievements, right? Such an arrogant personality. The kind of power the Fed has, where a single look can make the market tremble, is something Trump desperately wants. A government of a democratic country longing for dictatorship. Trump doesn't even bother with the surface-level pretenses anymore. It's written all over his face and displayed before the world. So now, what everyone cares about isn't just who takes over, but whether Warsh, once he arrives, is there to change the script or to continue being the gatekeeper. That's the real thing to watch for.
Kevin Warsh is a candidate to succeed Jerome Powell, not just because Donald Trump favors him, but also because he has a very unique background. From 2002 to 2006, he was a White House economic advisor. Then, from 2006 to 2011, he served on the Fed board right through the 2008 financial crisis. During Ben Bernanke's chairmanship, he was involved in policy communication and crisis response. In other words, he's not just an academic or a politician. He understands the central bank, the White House, and how Wall Street operates.
Looking at this meeting, Kevin Warsh, as the sole presidential nominee, will likely take over from Powell. What's Warsh's background? He's been in the White House and the Fed, lived through the 2008 crisis, and knows crypto well. His stance is quite friendly. And the crypto market, it's very sensitive to US dollar liquidity. When the dollar gets expensive, risky assets get squeezed. When it's cheap, they soar. So, to understand Warsh, don't just look at his resume. We need to see how past Fed chairs have managed things. They've controlled the market's financial script.
Paul Volcker served as Fed chair from 1979 to 1987. His strategy was simple: high interest rates to fight inflation. Today, it's the same. Higher rates mean a stronger dollar and tighter money, which hurts risky assets. Growth stocks, gold, and crypto, assets driven by expectations, fear this kind of chair. Alan Greenspan was Fed chair from 1987 to 2006. His biggest legacy wasn't a specific rate change, but an expectation. If the market stumbled, the Fed would likely step in to support it. This phenomenon eventually became widely known as what is called the Greenspan put. Many speculators and investors kept on betting in the markets because they strongly believed that if the market ever fell too far, the central bank would not simply stand by and do nothing. Ben Bernanke was Fed chair from 2006 to 2014. After the 2008 crisis, he slashed rates to near zero and launched massive quantitative easing. That's when the market first saw how much liquidity a central bank could truly provide. Bitcoin emerged in 2009, and the most important context behind it was the convergence of the crisis, low interest rates, and quantitative easing. In fact, without that round of liquidity injection, Bitcoin's anti-central bank narrative wouldn't have been so strong.
So the previous few chairs actually had little to do with the crypto world. At most, they were just setting the stage for its narrative. Bitcoin appeared in 2008, so the one who truly sent Bitcoin to the moon and then personally squeezed out the bubble layer by layer was Powell. Because under him, everyone experienced for the first time a full cycle of the most aggressive liquidity injection and extreme rise, followed by the harshest tightening and extreme decline. So it was this moment with Powell that made the entire crypto world finally understand. Cryptocurrency is at the bottom of the pile. It's the most dependent on dollar liquidity, and it's the most sensitive to the Fed's every move.
Janet Yellen served as the Fed chair from 2014 to 2018, although she wasn't the most radical dove. The overall liquidity environment back then was still quite favorable. Risk appetite wasn't crushed, tech stocks remained strong, and the crypto market began to expand. The ICO boom in 2017 was actually inseparable from the support of low interest rates and the loose environment of that period. Jerome Powell has been the Fed chair since 2018. His biggest impact on the crypto world came after 2020. Since the pandemic hit, the Fed slashed interest rates to near zero while launching massive liquidity support. The result was direct. US stocks soared, tech stocks skyrocketed, and cryptocurrencies took off as well. Bitcoin, Ethereum, DeFi, NFTs, memes. Almost the entire industry benefited from this wave of dollar liquidity. In those years, the market's firmest belief was that if there's enough liquidity, everything will rise.
But by 2022, the story flipped. Powell aggressively hiked rates, turning off the tap completely. Bitcoin bottomed out near 15,000, and altcoins were absolutely decimated. So Powell taught the crypto world a lesson. A bull market can be blown up by liquidity, but that bubble can also be burst by it. So now everyone's wondering if Warsh takes over, can he just cut rates at will and release liquidity whenever he wants? Not exactly. Don't forget, while Powell's term as chair is ending, his term as a governor hasn't finished yet. In theory, Powell could still stay within the Fed system, continue to vote, and keep influencing policy decisions. So, in other words, the Fed doesn't just change its entire policy just because it gets a new chair. As crypto veterans, we understand one thing: the narrative determines what rises first, dollar liquidity determines how long it lasts, and the internal checks and balances within the Fed determine if the tap can truly be opened.
Kevin Warsh is currently the nominee for Fed chair and hasn't officially taken office yet, so the focus shouldn't just be on who's succeeding whom. What really matters is whether he'll make the dollar cheap again once he's in. If he starts cutting rates immediately, it'll obviously benefit risk assets in the short term. Bitcoin, Ethereum, and altcoins will all ride the narrative of returning liquidity. But if the market feels the Fed is being pushed by the White House, the subsequent trades won't just be about liquidity gains. They'll also factor in risks to dollar credibility and inflation expectations. Conversely, If he insists on independence and keeps eyeing inflation, the crypto world might not be comfortable in the short term. The market wants rate cuts, not a chairman who just says, "I'm looking at the data."
So, during Janet Yellen's years, she maintained a low interest rate environment. As for Jerome Powell, he perfectly executed the cycle of first easing and then tightening liquidity. As crypto investors, everyone is very optimistic about Warsh's future appointment. You can feel it from today's price surge, right? But there is one data point or one aspect that everyone must understand. Currently, the United States holds about 4 to 5 million bitcoins. If Bitcoin derivatives are issued in the future and another 1 or 2 million are brought under US control, then the US share could reach around 7 million, accounting for over a quarter of the market share. So do you think Warsh or Wall Street actually wants Bitcoin to go up, or do they want it to go down? I believe the answer to that question is as plain as day, and it really could not be any clearer. Alright, that's our detailed breakdown of the Federal Reserve for today. We don't just look at the news headlines, we want to break down and analyze the depth and breadth of the situation for you so you can truly understand the logic and reasoning behind the entire crypto world and how it all fits together. So that when you invest in crypto, you can have a rational decision-making process. We hope you'll join our membership. All our member benefits are in there. We also hope you'll give us a like to show your support for the show. We want to hustle with you, and let's all get rich slowly together. See you tomorrow.